Welcome, everybody, to Lusk Perspectives. My name is Richard Green. I'm director of the USC Lusk Center for Real Estate. It's my pleasure today to welcome Torsten Sløk, chief economist for Deutsche Bank Securities. I was just reminiscing with Torsten that we first met in 2011 at a Bank of Korea conference on the financial crisis and how to avoid having financial crises in the future. Torsten is someone, if you're not on his mailing list, you want to try to get on it because he sends material that I find always thought-provoking and new. He has angles on the world that other people don't, and that's why I asked if he would participate with us today. And so without further ado, Torsten Sløk, thank you for being with us today.
Well, thanks so much, Richard. It's a real honor to be here, and I have really looked forward to this. What I'm going to do now is I'm going to share my screen and walk through my presentation. And as you and I talked about recently, the logic would be to spend about half an hour on talking about the economic outlook and where we see things going and where things have been during this recession and this difficult period that we're going through, for both from a health perspective and from an economic perspective. And then try to offer some perspectives of what will the shape of the recovery look like and what is the outlook overall going forward from here. So what I'm going to basically talk about is, in very simple words, first of all, where are we in this crisis and how should we think about what we've been through for the last several months and what is the speed of progression in terms of the different things that are going on. And I think this first chart here that I'm showing on this screen is an attempt to try to summarize this as simply as possible. The line in this chart here shows you the number of countries in the world with a higher than 5% growth rate in the daily number of confirmed coronavirus cases. The red line is VIX. As you know, VIX measures implied volatility in equity markets. In other words, over the next 30 days, what is the implied volatility in options markets in terms of what is the dispersion of views in terms of where we are going. And as you can see, the correlation in this chart here for both series showed that the blue line, from a health perspective, we saw the peak in the number of new cases growing at the fastest rate was around late March. And then, of course, as economies around the world, of course, very important in the US, began to go into lockdown and shutdown, and different countries did this differently. There's some different stringency measures with how this was done in different countries. Even for the US, there's also stringency measures with how was this done and what was the different levels of how stringent and how the meeting was implemented. But the main conclusion, as you can see, is that from basically late March up until the middle of April, we saw the blue line come down, and it came down relatively quickly. And then as we got into the second half of April and to where we are today, the line is still falling, but it's just falling at a slower rate. So the good news is trend is your friend in the blue line. We're certainly still seeing globally the number of new cases. In other words, the growth rate in how bad it is has been slowing down. And with the same thing in the red line, the VIX, which was not driven as such by the blue line, but was driven more by what the Fed was doing and what fiscal policy was doing, that has also been coming down. And again, very similar picture, coming down very quickly from late March until the middle of April. And then since the middle of April, red line has still been falling, but it's just been falling at a slower rate. So as I've written in the title, the virus peaked 2 months ago and market stress is going away, but the speed of progress is slowing. But the news is things are generally getting better. And this, of course, is very important. This, of course, brings me to the general agenda and the general way that I have organized the presentation here today, namely that there are 3 different crises that we are fighting or battling. We are fighting a health crisis. I'll show you a few charts in terms of what's going on with the virus, what is the curve doing in terms of the virus globally in the US, and there's a lot of other data for the US that we could have talked about, but just speaking, the virus curve is flattening out. So let's just take a few pictures and figure out what does that mean in terms of the specifics, in particular for the US, and more importantly, where is the US relative to countries, including Europe and, of course, Italy and elsewhere, where they have done more, and what does that mean for how we think the outlook for the US health situation overall. Then I have a few charts about financial markets. What does the financial markets curve, if you will, look like? Is it flattening out? Are things still getting worse? And obviously, as we know, and as I've written here, financial markets are stabilizing. And the third and final crisis that we are battling with, and we will be battling with for quite some time, is of course the economic crisis. So in summary, the way that we think about what's going on at the moment is that you need to categorize your thinking into asking questions about, well, how far along are we in battling in the virus crisis? How far along are we in battling in the financial market crisis? And finally, how far along are we in battling the economic crisis that has come along? And finally, I'll end up, this is what I do in my job, so I need to have a chart with investment implications. So I have a picture at the end that talks about what are the investment implications for rates, FX, credit, and equities, in other words, for different financial markets. Richard and I spoke about, when we discussed doing this presentation, that I could brought along a lot of different charts about housing starts and housing perms and different demographics in the housing market. But you all on this call here know these things much better than me. So I thought it would be hopefully more valuable to think about this from a sort of macroeconomic and a market perspective, which is why the presentation is organized around these three different bullet points of maybe looking first at the virus curve, then the financial market situation, and then the economic situation. So with that little agenda, let's first look at some of the curves for what's going on with the virus. This chart here, if you look at the text below the title, shows you new confirmed cases of COVID-19 in the US and Italy. What's interesting here is, as you can see, so I basically moved the lines, and it used to be the case that the US was in round numbers about 2 weeks behind Italy. And as you can see, this trend was following along quite nicely for a few weeks there in the beginning of April. But then we began to see the red line still stay relatively elevated compared to the blue line coming down. So that's why a very important part of the conversation in markets, and of course we all talk about all the time, is what I've written in the title, namely lack of social distancing means that the US is now more than 2 weeks behind Italy. In other words, the red line is still moving down, but you can do a lot of different pictures looking at the US outside of New York City and the tri-state area, and you will see the line a lot flatter relative to what you have, of course, in New York, where you had a shutdown that was much more stringent and the mitigation measures were much more severe. So that's why one thing that many I talk to in the pension fund community in Europe, I talk to a lot of asset managers here in the US and in Boston and on the West Coast, and of course also talk to banks and investors in Japan and Taiwan. One conversation about this chart here is that people are beginning to say, well, where is it more likely we have a second wave? Where is it more likely that there might be more virus for longer? And this chart here tells you that there is a risk that the US could be somewhat behind, at least on some fronts, and we are monitoring very carefully to what extent the red line is going down. And if you really take your ruler out here, you could see that for the last 2 or 3 weeks or so, the red line, it could actually be painted a picture that has moved more sideways. So this makes you a little bit worried that the US really needs to see the line continue to go down. Otherwise, we will come back and think about conversations in terms of what does this mean if you're not seeing this improvement in the overall level of the number of cases. And one case that internationally, of course, is getting a lot of example is Sweden, which is the red line here. So now, just to be clear, what does this chart show? If you look at the text below the title, this is new confirmed cases of COVID-19 in the US, ex-New York and Sweden. And Sweden never had a shutdown. They never closed schools. They never closed stores. They never closed workplaces. US, outside of New York, which is the line, you now look at this and say, okay, now it's beginning to look a little bit like a similar picture. And now you're beginning to wonder, okay, so didn't have a shutdown, and still the pattern looks actually relatively similar to what we see in the US outside of the tri-state area. So this is also why a lot of conversations I have with investors are about this idea that, well, maybe the chances of a second wave, and maybe this idea that, oh, now we should just quickly reopen, maybe those things do become an important part of the conversation in terms of, well, what are the risks if you didn't have the social distancing that was required? And what are the risks if the US now enters a situation similar to Sweden that have had, of course, a higher level of people who have died, a lot of higher level of people who've been infected? The main conclusion still is, despite those two pictures, that if you look at the number of cumulative deaths, which is what this chart here shows you, if you look at the text below the title, cumulative deaths from COVID-19 in the G7 and Sweden, and this is a 7-day moving average. The promising story, if you will, in the overall scheme of things is that even in Sweden, and forgive me for spending so much time on Sweden, but it turns out to be a very, very important experiment what Sweden actually did. We can discuss, and this is not a political debate, we can discuss whether Sweden have had too many people that have died or not, and whether they have the right strategy or not. But even though Sweden didn't have a shutdown, it is still the case in the black line that Sweden has actually been able to flatten the curve. So this gives some confidence that maybe, even in the US, we will be able to flatten the curve. So the bottom line in these pictures here, and there's many other ways and many other charts that you could bring along to a discussion about this, but the bottom line here is that if I'm a global asset allocator and I think about where should I invest, or in your words, where should I be looking at the housing market coming back faster relative to where, then this chart at least gives you some confidence that Sweden and those places that did still not have a shutdown have actually been able to do reasonably well. So we are in the camp of those who do not believe that we will have a second wave. We are, of course, monitoring these charts on a daily basis. My team updates this all the time. But the main conclusion is it looks like things are generally moving in the right direction, which, of course, still gives us confidence that for now it is possible to flatten the curve on the virus front, even without necessarily another shutdown later this year. So the main conclusion is, number one is, very simply said, the virus is flattening out. And we are, of course, very pleased to see that, because the virus and what the virus does drives everything in markets. It drives everything in the shape of the recovery. So therefore, it is the first domino brick, no matter how you look at it, when you think about what will be happening to markets and what will be happening to the economy. So let me now turn to financial markets and what has been happening in response, of course, to the virus breaking out. And this chart here shows you, I know there's a lot of different things going on here, but this chart here just shows you in very simple, plain English, what have central banks done in different countries in response to the turbulence that we saw in financial markets. And over there to the left, you see monetary policies. Of course, central banks in the G7 countries and China, which is what you see here, they've been cutting interest rates, they've been providing liquidity support, we have swap lines, we have asset purchases. All these, the Y means yes, this is where they did that. And you can see they basically all did the same thing, namely very aggressively cutting rates, very aggressively supporting financial markets. X policies, we have had very little policy change when it comes to intervention and capital flow measures. When it comes to different things that have been for the banks, which of course is very important from a financing perspective, also for real estate and what's going on in mortgages. Of course, the different things, as you can see, in different countries, but the big picture also is a number of initiatives that have been helpful for the banking sector. And finally, financial policies for borrowers, state loans or credit guarantees, restricting loan terms or moratorium payments. This is, of course, something that's all too familiar when it comes to mortgage forbearance and everything that we've been debating so much more recently. But the main conclusion is this chart here on its own shows you that it was pretty aggressive what was done. And it was not only in the US here that we did this, this was done globally. And that, of course, also just tells you that the central banks were completely on top of this very, very quickly. One very important point, in my view, also looking ahead, is that this crisis was not caused by homeowners or mortgage services or banks or anyone else. This was literally a natural disaster. So it was in some sense relatively easy for the central banks because the political support was very significant for the central banks to go out and support things. And that's why the central banks have been so relatively successful. This next chart, if you look at the text below the title, shows you financial stress in the United States. There are various measures of financial stress. One simple way of talking about financial stress is that if I throw into my kitchen sink different measures, the stock market, credit spreads, mortgage rates, if I throw in different indicators of what's going on with investment grade credit, commercial paper, and I do principal component and I try to extract what is the common factor that these financial indicators have that can give me in one indicator an idea about what financial distress is there in the US financial system at the moment. And there are two different indicators that do that. The blue line is the OFR. The OFR is the Office of Financial Research at the Treasury Department. They have a financial stress index. This is daily. Bloomberg in the red line also has a financial distress index. And the big picture here, as you can see, is that when it peaked over here to the right, you could see that we saw for both indicators a level of financial distress that was nowhere near where we were in 2008 and 9, but it was, of course, very bad relative to what we've seen for the last 10 years. And, of course, the central bank action that we just saw pushed us back very significantly, where the level of financial distress is now, we're not quite back if you look at the blue and the red line. There are some finer nuances econometrically and statistically about how this is measured. But the main conclusion is that you can see we're not quite back to where we were in February, but the trend is certainly your friend when it comes to financial system easing in terms of distresses overall. And of course, the main thing that we all hear about all the time is, of course, what's going on in the stock market. One way of looking at this at the broadest level is to look at the total value of the global stock market. And the total value of the global stock market, so think about the value of the S&P 500, the DAX, the FTSE, adding up global financial markets from the equity side, you get that the global financial market was about 90 trillion in February. Then it dropped to, in round numbers, around 60 trillion. So we had a loss of equity of around 30 trillion, basically in a matter of weeks, which we all know was very dramatic. Then central banks came in and did a lot. And now we're crawling out of this hole. Some would say we're moving out very quickly, but we're crawling out of this hole relatively rapidly now, back to roughly 78, 79 trillion overall. So now we're quote unquote just back from 10 trillion down from where we were at the peak. Then we can, and I'll talk about that in a minute, we can talk about whether this is too overvalued or other things, but the main conclusion is this, of course, is very helpful for corporate America. This is helpful for anyone who's looking to finance themselves. And one very important aspect of what has been happening with this crisis is to think about what was the problem, what was the shock that hit the economy when we suddenly saw the virus came along and all businesses started closing. Well, if we had a coffee shop here in Brooklyn where I live, we would suddenly see no sales. We would no longer sell coffee. So therefore, we would no longer have any revenue. And what the Fed did in response to this, of course, was to make sure and say, well, gee, we're not getting any revenue in our coffee shop. What can we do as the Federal Reserve? Well, we can make it possible for those businesses that lack revenue to go and borrow in commercial paper markets, to go and borrow in IG markets, to go and borrow in some parts of high yield markets. And this chart here shows you what were interest rates in commercial paper. In other words, if we were a corporate that needed money and we didn't get any revenue, substitute the lack of revenue by borrowing in commercial paper markets. And you can see here, borrowing costs in commercial paper markets, both in the blue line for financial commercial paper. This is commercial paper minus OAS, but this is the spread. But this is just a complicated way of saying, what are the costs if I'm a company and I need to borrow? And if you're a financial company, if you're not financial, as you can see, the answer is those costs are essentially back to where they were in February. So the Fed has been extremely successful in narrowing and pushing down the cost of borrowing for corporates. This is also what you see further out the credit curve. This is the level of yield in investment credit, which is the blue line. You can see the blue line is actually back also in level term where it was in February. High yield is a little bit special because high yield, as you know, in the credit stack, some parts of high yield are lower rated, CCC, and for a while it was also energy hard hit with oil prices being so low. This, of course, was creating a lot of distress in lower rated quality in CLOs and loans and things that have low ratings. But the main conclusion, if you look at the red line, as you can see, is that we're not quite back to where we were in February, but we've certainly also seen significant improvements, broadly speaking, when it comes to high yield. One footnote when it comes to the bigger picture of financing, when you think about the U.S. economy, one thing that's really important to keep in mind is to think about this from your economics textbook, the Modigliani-Miller theorem, which talks about the financing of the corporate sector. This chart here shows you that there's actually very significant differences in terms of sources of financing for the corporate sector. To the left, you see that in the United States, the yellow bank loans actually make up only a very small part of financing for the corporate sector, and the vast majority of financing for the corporate sector, as you can see, is the green and the red, namely IG bonds that are rated in different qualities, but also high yields and institutional loans. This is very different from Europe, that the vast majority of financing for the corporate sector is the banking sector. So this becomes very important when you then start thinking about, well, if you have a shutdown of the corporate sector, in other words, if there's no revenue in the corporate sector because the economy is shutting down, well, it does matter a heck of a lot what is the sources of financing, whether it's something that happens in the banking sector or something that happens in the market. And that is, of course, very important for how banks should be responding. And the final point, of course, on this is to think about the vulnerabilities. And I'm not going to walk through this because I want to get to the economics and the economic outlook. But there are, of course, now some people who are beginning to say, well, wait a minute. If I think about, if you look at the text below, the text and the title here, key vulnerabilities in high yield loan and private credit markets. As you know, there's been discussion over the last few years that the loan markets have grown significantly. And you have also seen high yield markets grow significantly. So here are just different ways of thinking about, well, what are some of the risks when we look ahead about what is going on in high yield markets, what's going on in loan markets, what's going on in private debt markets. But the main conclusion is that there's still some issues in credit. Although the Fed has been very helpful and they've been very forceful in the way that they've been dealing with things, there's still a number of issues when we think about private credit that are making us somewhat worried about what is ahead in terms of the sustainability for credit markets, in terms of where things are going. But the main conclusion still is, and this is summarized in this wonderful chart, that the support from the Fed has just been completely supportive and full and very aggressive. And this has now brought the conversation in financial markets to this picture here. This shows you the forward multiple for the S&P 500. So what does that mean? That means what is the PE ratio 12 months ahead on expectations that analysts have today? And as you can see, the forward multiple is 22. And it's not rocket science. As you can see, it looks like the stock market is heavily overvalued. So one question that I'm getting literally every day, and I talk to clients around the world about all the time, is why is it that the stock market keeps on going up when the outlook for the E in the PE ratio is so relatively weak? And of course, the answer is that the Fed is providing this enormous support to credit markets. We still have a lot of people that are underweight equities. We still have that the economic data, as we're seeing literally today, continues to get better. So that means that we're crawling out of the hole, crawling out of the canyon. So all these things and sentiment combined, and also adding any optimist views on vaccines and other things, continues to push equities higher. But it does look like that we are getting to a point where valuations are relatively stretched compared to the historical picture, as you can see in this picture here. Let me end now with a final idea, namely about the economic outlook. So what have I told you up to this point? Well, up to this point, I've told you two things. And those two things are actually relatively upbeat, that the virus curve looks relatively good and financial markets look relatively good. We can debate what's going up and whether you agree that this is something that should happen or not happen. But the bottom line where we sit right now is that on both these fronts, it looks like we have things relatively and reasonably well under control. So let's now talk about the third and final bullet point on my agenda, namely the economic recovery and what's going on, and where we are much more worried about things not getting quickly fixed. In this picture here, I've tried to list what I've written in the title, namely the behavioral changes that are going to slow growth over the coming quarters. And when I work at the IMF, the work at the IMF is really organized around these three different areas: the household sector, the corporate sector, and the government sector. And the fourth sector that the IMF always looks at, of course, is the external sector. But if you think about this from a macroeconomic perspective, this is a bit of a dog's breakfast of different things that you can start worrying about. But look at the household sector. What are the behavioral changes we should be worrying about? Increase in, if I read through the first bullet point, increase in precautionary savings for households, similar to what we saw after the Great Depression. In other words, households are saving a lot of money. That, of course, means that the saving rate will go up. If I save more money, that means my consumption will go down. If I need to rebuild my savings, that means that my consumption will, by definition, go down. So consumption is probably going to be weak because households need to rebuild their savings up to where they were before the crisis came along. More space between seats at restaurants, cinemas, events, concerts, conferences, trains, buses, airplanes. Fewer people traveling on vacation, going out until we have a vaccine, all contributing to lower consumer spending. Older generation staying at home until a vaccine is released. Less willingness to put your parents in retirement homes. Limits on the number of people in supermarkets at the same time. More online shopping, more online doctor visits. Fewer people going to fitness center, doing group sports. More people driving their own car to avoid public transportation. Health insurance going up. So you could say, wow, this is really a lot of different things. How do I think about this? The way I think about this is that when I talk to a lot of hedge funds and a lot of people who are active in quant investing, you will normally look at some very simple indicators, say leverage. I would have a screen of companies that I like that have low leverage. I don't like companies that have high leverage. Okay, so that gives me some names. I have a different screen of names. Some companies that have high profit growth or high EBITDA or high earnings growth. I like them. I don't like those that have low earnings growth. I have another screen that tells me something about companies that have invested in R&D, relative to low investment in R&D. And I'll try to find the common factor of companies and I would invest in them. And this is what quant models do. They try to find statistical patterns and they try to rank these according to where are the most profitable historically returns. Well, those indicators are the ones that you'll be looking at. What they're telling you, and this is really important for markets, is that now there's a whole new factor, or in factor language or in principal component analysis, that there's something missing in the kitchen sink that becomes important as a driver of what markets will be doing. That's why so many quant funds are struggling at the moment, simply because the new dimensions of social distancing, suddenly you should not look at companies according to leverage and profit growth and R&D growth. Now you have to look at, is this a business that's in social face-to-face or social distancing is significant or not significant? Is this something that matters for older generations relative to younger generations? So what has really caused a lot of problems for the investment community is that quant funds are struggling big time because they don't have a history of data helping them understand what the patterns are that they should be looking for, because they're not seeing these variables very well that now are becoming important for the household sector. And the simplest way of thinking about this in the economic outlook is in this chart here. This shows you the share of total US consumer expenditures by age. So look at this, people that are more than 65 years old, they account for 20% of consumer spending. US, people that are more than 55 years old, they account for more than 40% of consumer spending. As you can see, these trends have been going up because there are more baby boomers, there are more people in the older generation. And the problem is that people in the older generation, of course, if they're going to stay home until there is a vaccine, then the risk is that they may therefore lower their consumer spending. Not only are they not going out to eat at restaurants and fly in airplanes and go on cruises, but there's also more evidence, if you look at the daily data for auto purchases, that they're not out browsing for cars, they're not out browsing for electronics, for furniture, and for washers and dryers and everything that you could look at from a consumer goods perspective. So the main conclusion is this is also holding back consumption more broadly for the older generation. So the first problem looking ahead is that the older generation might be staying home. And this is an issue when you think about the risks overall from a consumer perspective. Then some people look at this chart, and different people send me all kinds of stories, arguments all the time why I'm wrong and also sometimes why I'm right. But one picture, of course, that's important is to try to then track daily data for restaurant attendance and whether people are actually going out or not. There is from Open Table, which you should know is the app on your phone where you do restaurant bookings. We have been quite surprised in some states, here Texas, Tennessee, and Georgia, that we have had quite a move up in the number of people that are going out again. I know my econometrics teacher and Richard will probably not too proud of my guidelines here and what I did. I just ran a regression on a time trend, and I tried to ask the question, when are we back to anything that looks normal? And there's a lot of things going on to whether this is actually going to be the scenario or not. But the main conclusion is it looks like this will be a slow crawl out of the hole. And this is why what we have in this chart here, when you look at the shape of the recovery, we spend a lot of time talking about the GDP level and where we are now relative to where we've been historically. Remember here, and this is important, in the financial crisis in 2008 and 9, it took about 2 years before we got back to the level of GDP that we had before the crisis. And now we are talking a lot about, is it a V, is it U, is it L, is it Nike swoosh, what exactly is the shape of the recovery? I would say this is more like a deep V, but because the V is so deep, it's actually going to take time to come out of this. So it may actually take more time over here to get out of this before we get back to the pre-virus level relative to what we saw earlier. So yes, it actually does look like a V, but the V is so deep that it will take a very long time. And we have our Deutsche Bank forecast, which is the red line. We have the CBO, the Congressional Budget Office forecast, which is the dotted red line, and the blue chip, which is the consensus. And all of them tell the same story. It is going to be a long, long period before we get out of this and get to the end of this problem we have ahead of us with consumer spending being so depressed.
Torsten, can you go back to that chart for a minute? Because there's just one thing I just want some clarification on. Thank you.
Yep.
There it is. Why is the left-hand axis labeled differently than the right-hand axis?
So that's because my research assistant made this problem, and I have fixed that, and the email that you got from me today had the right axis. But the answer is that this is all in 20 trillion, and on the left-hand axis is wrong. But the picture doesn't change. Both of them are the same.
I wanted to make sure I wasn't missing some subtle point here. So thank you.
Good. The picture is the same. It shows the exact same because it's all on the right-hand side that they are anchored, the three series here.
Thank you so much.
Now that I skipped the images because this is important for many people who are listening in here now also. Now, of course, a lot of what I mentioned in the beginning was that the central banks have been providing a lot of action. Now, we could all agree in the housing market, when I sit down with our housing analyst and I sit down with our securitization group in mortgages, of course, the conversation is, well, it's good that the Fed is providing liquidity support so I can get a loan. But what about the fundamental issue that people fall behind on their mortgages? And that here is the worst chart, if you will, or the fear you can have when you are in the housing industry and the housing market. This shows you the red line is that the unemployment rate has gone up a lot. The problem is that historically the unemployment rate in the blue line highly correlated with the loan delinquency rate. And as you can see, the longer the blue line stays elevated, the more problematic it will be for households. So another way of saying that is that the forecast that I just showed you here and the CBO forecast, the CBO estimates, and this is similar to our number, that the unemployment rate at the end of this year will still be more than 10%. If you're still more than 10% that are unemployed, I begin to worry from a macro perspective that we will transition away from just a liquidity crisis to also being a solvency crisis, where many homeowners will begin to not be able to pay their mortgages, and you'll begin to see across the score spectrum trouble with people not paying their bills simply because delinquency rates will start to go up. As you know, all better than me, many people didn't pay their mortgage on the 1st, and many didn't pay on May the 1st, and then now on June the 1st, which was literally just a few days ago. Also, many people didn't pay, and the important part of that is that now we suddenly hit the 90-day delinquency rate. And as you know all better than me, when the 90-day delinquency rate goes up, that begins to open up a whole range of legal issues about what happens to auto loans when people are 90-day delinquent. Well, then you could do repossession of the car. You could show up outside my house and repossess my car and drive away with it. The same thing, of course, for credit cards when the 90-day delinquency rate starts to move up. So there's a lot of issues going to doing your homework in terms of monitoring what's going on with different types of consumer credit and, of course, most importantly, mortgages. And the same thing comes on the corporate side. Now the blue line again is the unemployment rate, and the red line is now Chapter 11 bankruptcy filings. And as you can see, this is also again moving this risk back to the table, that's saying, well, maybe this is not just a liquidity crisis. Maybe there is a risk that this becomes a fiscal crisis in terms of solvency, and maybe therefore we will have more problems with people not being able to pay their loans. Now you could then say, wow, gee, this spells a lot of bad stories for financial markets. Why are equities so high? Well, the important thing about this is also that, of course, politicians in DC and around the world are seeing the same pictures. So what really becomes critical when you talk about what financial markets should be doing is that I'm 100% confident that Washington, D.C. is watching the exact same data that we are watching and are exactly observing that if there is a deterioration in delinquency rates, if there's more increase in defaults and foreclosures, of course, they might be coming with more in terms of initiatives. So this becomes a very difficult situation where, yeah, I know fundamentals are deteriorating, but maybe I should also be spending a significant amount of time figuring out what Nancy Pelosi and Chuck Schumer and Mitch McConnell and Trump and what they're going to do and what Mnuchin and company also can come up with in terms of responses to where this deterioration take us if nothing is being done. So with that, let me end with the last chart. And forgive me for showing you this, but this is what I do in my job, namely provide investigations and investment recommendations for asset allocators and global investors. And just for the sake of the argument, I know this is not and it's nothing to do with the housing market as such, but I think it does provide a backdrop for you, at least in terms of how I think about what's going on and what will be happening going forward. So what the Fed is doing with the Fed is on hold. GDP will decline 39% in the second quarter. The CBO estimates that the unemployment rate will be 10% by the end of this year. This is very important for everything in housing. Bond markets within 10-year rates will slowly move higher. The Fed tapering and exit from lockdown is pushing long rates higher. We think the curve will be steeper by the end of this year. Of course, the Fed is engaged, and we could talk about literally in a lot of QE and a lot of buying, in particular in the front end of the yield curve. They're not buying in the long end as aggressively as they are in the front end. And in the front end, a lot of the issuance from the Treasury is T-bills. So the Fed and the Treasury are meeting in the front end of the yield curve. But there's a lot of issues going into when you have such a significant fiscal expansion. What does that mean across the yield curve in terms of what would the curve look like, and what does the particular, of course, for long rates? Credit spreads, we still think credit spreads will go narrower. Fed support and more liquid markets will narrow IG and high yield spreads over the coming quarters. Stock markets with flatter epi curve, this is the epidemiology curve, meaning the health curve, and the recession curve should also generally be better. Fed liquidity support and exit from lockdown will push equities higher. S&P 500 will, in our view, be 3250 by the end of this year. In other words, stocks going up from where we are. In other words, not heard Jay Powell complain about valuations. He doesn't talk about the forward multiple. All he talks is carrying the economy over the river across to the other side to get on the other side of the virus. We think the dollar will go down. We think euro dollar will go to 120. The dollar has been going down more recently. We think it will continue because the spread between U.S. rates and bonds, the spread between U.S. rates and global rates has narrowed both in the front and the long because the Fed has been lowering rates and long rates has been coming down. Commodities are rebounding, of course, but a lot of this is because the economy is reopening. As you know, one important statistic is 40% of oil demand goes to trucks and cars. So if there's no trucks and cars on the roads, of course, there's very little oil demand. Now that trucks and cars are coming back, people might even be driving their car. That means that you will see more demand for oil. And of course, that's why oil prices are going. Finally, emerging markets, I didn't talk too much about that, but that's, of course, also one area where the virus has been, of course, having a very significant impact. So I ran a little bit over time there, Richard. Sorry about that, but let me stop there and turn it back to you.
Totally fine, Torsten. And so a question I've gotten, and first of all, will you share your slides with us?
Yes.
Great, thank you. So we will post them on the Lusk Perspectives website, so look for that coming soon. Thank you. Before I turn it over to audience questions, I have a few of my own. You showed the really interesting slide about the number of countries where COVID cases are rising by 5% a day. On a population-weighted basis, do you have a sense of what that would look like?
That's a really good point. So now you can exactly think about emerging markets and places like India and elsewhere where you're certainly still seeing deterioration. There is a lot of issues going into your point. It's just, and so as we all know too well, here, if you look at the x-axis, this is just time. And on the left axis, I just have the number of countries. So you're absolutely right. The number of countries this is Liechtenstein and China on the same chart. So in some sense, this is misleading. But it still gives, at least from a broad perspective, the idea that at least globally, things look like they're more under control. There's a lot of discussion in EM and among EM investors about that this chart does not look like this for EM alone. So you're right. There's a lot going into this is just waving my arms over Iceland relative to India. But there's certainly a lot of issues to your point. So absolutely.
And then along those lines, if you took New York out, what is the growth rate in the U.S.? I should know that, but I don't.
Yeah, so it's still less than 5%. But if you look at the chart that I have here, I think I showed you this one here. I still think that the important thing that, of course, is worthwhile thinking about, and this is, of course, what we talked about. We have different epidemiologists. We talked to one in the UK and two here in the US, and we discuss this with them all the time. And of course, hedge funds I talk to, they have an army of doctors and epidemiologists that try to look at the blue line here and say, is this flattening out? Is it just driven by New York? Can we continue to reopen? I mean, all the things that go into conversations about whether this is flattening out or not. And this is why there are many different camps, the bit offer, if you will, in this conversation is very wide. I meet people who say, of course, we'll have a second wave. And I meet other people who say, no, they absolutely not. Sweden shows that things are under control, so there's nothing about. So absolutely, you're right that there's a lot of stuff going into looking at an individual state level and individual considerations about what exactly are the likelihoods that we will have this under control and the likelihoods that we will not have this under control. In other words, from a finance perspective, I would like to assign a probability to the good outcome and a probability to the bad outcome. And this is, of course, what investors try to do all the time. This is not what's happening in equity markets for the other reasons I mentioned, but it certainly is very important because if the market suddenly comes back and says, gee, things are actually much worse, then we could have a significant reversal also of what's going on in equities.
So you made a really interesting point about all this debt potentially leading to a debt crisis, but your forecast is that long-term treasuries go up a little bit, but only a little bit. So if you look at just doing some math in my head, is that if a year ago, 10-year treasuries were at about 2%, they were actually a little higher, and now they're going to remain under 1%. That means when you issue 10 years, the interest is half what it used to be. As much as we've added to debt, we haven't remotely doubled it. And so is it possible that we actually see debt service as a share of GDP fall as a result of all of this?
Absolutely. But that, as you, of course, and as you and I have spoken about also many times, that, of course, also brings the conversation to Japan that has incredibly high debt levels, 250% of GDP. And it's true that it is sustainable as long as interest rates are zero. But then you start asking, okay, what's the difference between Japan and the US? In Japan, 96% of JGBs of government debt is held domestically inside Japan. So in that sense, Japan is not vulnerable to the rest of the world things. In the US, about a third of US treasuries are held by foreigners. And as a footnote, about a third of US investment grade credit is also held by foreigners. So we suddenly become actually very sensitive in the US case to what the rest of the world thinks about US policy making, both what they think about fiscal policy, monetary policy, the credibility of the regime. If Jay Powell is replaced by someone in February of 2022 and the central bank and the Fed in this case starts to have different credibility, then you start wondering, what does that mean for the rest of the world for investing in the US? So you're right. Absolutely. If interest rates are low, we will not have a debt problem. And this is what Japan shows. But the big difference and I know I'm talking as someone who worked at the IMF for many years before I came to Deutsche Bank. If you have an issue where a lot of the debt is held abroad, and just again, know too well, this is what we're seeing over the last several years in Turkey, Argentina, South Africa. Many emerging markets have had this fact that suddenly the rest of the world doesn't want to finance things anymore. And we can then say, well, the US is a global reserve currency, so this will never happen. And I have a lot of sympathy for that. But all I'm saying is that there's a debt that needs to be rolled over, and the more debt levels go up, it is beginning to raise the issue, as I was alluding to also, does the Fed then need to buy a lot of 10-year bonds? The Fed has been very aggressively saying, we only want to do yield curve control and buying in the front end of the yield curve. We are not keen on buying in the long end. The Fed minutes for every meeting, including the last set that came out, have been emphasizing, we don't want to bail out politicians. We don't want to buy the long end. We want the long end to be trading on its own. So that's why a lot of the questions around what you're asking about here are very, very important, and of course, particularly important for the housing market and for mortgage rates. But so far, where we sit right now, yes, it's true, servicing costs are low, but the vulnerabilities, by any way you look at it, have certainly gone up.
So I'm going to segue into a question from a member of our audience, James Kim, because it relates to the rest of the world investing in the U.S. And one of the things, of course, is China has substantially slowed, in fact, reversed its investment in the U.S. over the last several years. It doesn't seem to have mattered all that much to the U.S. economy. And so James's question is, will the Hong Kong conflict crisis affect the global economic recovery?
So one thing that is, of course, very interesting about that question is that the problem that I think is going on in financial markets is that this is a very unquantifiable risk. Think about it. We all have an MBA or economics degree, and we all sit and think about what's going on and how to quantify these risks. And suddenly someone comes in to, I have a spreadsheet for the US economy where I try to predict what GDP will do. And someone comes in and says, okay, there is something going on in Hong Kong and China. We may or may not have an escalation of something. And then they come in and say, well, now there's also riots and social unrest, and that may escalate or not escalate. And I have really no tools and ways of about whether this is going to get better or worse, any of these things. And likewise, now we have suddenly in Europe a situation where on the European Commission and the European Recovery Fund and Italy and Germany, and the problem is I just don't know how to stuff these things into my CAPM model. So I just don't really have any good framework for thinking about these risks. And the interesting thing is you could then say, well, why are you then putting zero weight on that? Doesn't that mean you should be putting a lot of weight on that if it's a risk that you don't understand? I mean, the macro textbook and the finance textbook will tell you that if you have a cloud coming in over the outlook that is an unquantifiable risk that I can't really diversify and I can't really go away from that risk, then I should really be hunkering down and going away from risky assets. But at this point, the market seems to just be saying, well, this is just, in particular on the China issue, this is just something that we've heard now for several years. I don't know how to quantify that risk. The market still went up for several years. So maybe now, again, the best approach is the market's conclusion, clearly, to not be overly worried about that issue. But the bottom line to your question is, and to James Good's question here, is that there's certainly a lot of risk that this could come like a jack out of the box and become a very significant issue if this turns out in the wrong way. And I don't have any scenarios exactly for what that means, but it's pretty clear that the tensions are growing, of course, with China. And there's also a lot of things that you could begin to worry about. Are we saying this has no impact on earnings for the S&P 500, no impact on the outlook for the US economy? And there are certainly scenarios where these things could become very important. So the problem is I just don't have a toolbox for quantifying these risks. And very interestingly, almost the psychological and sociology perspective, the market is now saying, you know what, I can't quantify that risk, so therefore I'm not going to worry about it.
I want to push this conversation just a little further because there is no doubt, there is certainty that China-US relationships have deteriorated, and yet today we have a argument over whose airplanes can land where this morning. Do you think there's a chance this will lead to onshoring of certain manufacturing processes, that the supply chain will be different, which means it will be perforce less efficient and therefore drive up the price of consumer goods?
So I do believe that this will and has already led to supply chain disruptions. The issue is that the way that consumer goods are measured, if you think about what is the weight in the CPI basket, the weight in the CPI basket to anything that has to do with the supply chain, if you think about even cars, the weight of cars in the CPI basket, meaning CPI basket, as you know, is what is my consumption and your consumption, and what is it that the money that I spend every month, what does that go to? And the biggest part of the CPI basket, as we all know on this, is housing. In round numbers, housing has a weight of around 40%, meaning 40% of my consumption goes to paying my mortgage or my rent. The next biggest component is healthcare. So healthcare has a weight in round numbers of around 20%. Then the next, so now we're already up to 60%. The next few are leisure, is travel, is transportation. Services overall have a weight of roughly around 2/3. So that means that supply chains and stuff that I buy in Walmart or that I buy in grocery stores or buy on Amazon actually has a relatively small weight in my consumption basket. So as much as you're right, we probably see higher prices of everything from ventilators and masks and medical equipment and medical devices that now have to be produced domestically. And that's going to be definitely more expensive. The weight to that in the CPI, the weight in our consumer spending is going to be much smaller relative to how much money we're going to spend on housing services, more broadly speaking. And the problem is when the unemployment rate goes up to 15% and many people lose their jobs, then the demand impact on inflation is going to be a lot bigger, which means that therefore we see much higher risk of deflation than we do of inflation. There are certain parts of the CPI that certainly will go up, but the vast majority of the CPI basket is at risk of going down. Most prominently for us, of course, here on this call, housing prices and what has to do with the market, and also everything that has to do with services more broadly, if the unemployment rate is double digits still by the end of the year. So the main conclusion is, yes, in the short term, and here I'm talking about the next 2 or 3 years, I still worry much more about much more downside risk to inflation than there is upside risk to inflation.
So you just answered half of Scott Shoppin's question. What I like to do is combine the second half of his with questions from Bob Alter and James Torres. The way I'll look at it, the way I'll ask it is this: is how do you see all of this affecting the different real estate food groups, housing, and in particular multifamily versus single family, retail, office, industrial, and hotel? And I will tell you, Robert owns a bunch of hotels, playing out over the next 6 months to a year or so.
So my main answer, and now remember you're talking to an economist, and this is what I do. So this answer is completely colored by my background on what I do. But my main problem is that if the unemployment rate today is 15%, and on Friday in our Deutsche Bank forecast, it will go up to 19%. And by the end of this year, according to the CBO, as I mentioned, it will be 10%. That is unfortunately not good environment, economically speaking. That's not good for residential real estate. That's not good for commercial real estate. It's not good for office space, apartments, hotels. It's not good across the board for anything in real estate when you unfortunately such a high level of unemployment. That being said, as you all know, and as all of you are much more aware than me, there's a lot of adjustments going on in business models. There's a lot of things that are going on in terms of activity. And the little issue, of course, that is a silver lining in this, as you alluded to also, Richard, that interest rates and mortgage rates have come down. They have not come down as much as the Fed and we all would like, but they have certainly come down. And the fact that interest rates have come down have actually shown quite a significant increase in mortgage purchase applications and, of course, also refi. People are actually fairly aggressively and actively trying to think about the mortgage finance. There's also a lot of issues with the forbearance initiatives, and there's a lot of issues. We haven't spoken about Fannie and Freddie for a little while, but I mean, now they're coming to the radar screen in terms of what can be done in terms of trying to dampen some of the negative impacts of having the unemployment rate so elevated for so long. So I would say, broadly speaking, the consumer and the unemployment rate would unfortunately be the first stop for me for thinking about the answer to your question. But specifically to your point, of course, when you begin to hear, and now again, I'm colored by living in New York City, a lot of people are moving out of Manhattan. I have people working for me in Deutsche Bank who basically are now saying, I'm going to leave Manhattan and move out to the suburbs because of fears of virus, because I think that's going on, meaning in broad terms with the mortgage market and the housing market, and maybe this has been accelerating this trend. So multifamily relative to single family has certainly also seen a very structural shift where more people are moving, at least for now, towards single family relative to multifamily. So the bottom line is that I still think that there's some structural stories inside different segments of the CRE and MBS that one can spend some time thinking about what they were looking like. But the short answer to your question is that if the CPO and the Fed and we have the forecast that the unemployment rate is still 10% by the end of the year, that means that we still have at least 6 months and maybe even more ahead of us where things are going to look relatively distressed. I will mention as a final point is that it's my impression that there are some investors out there, including some hedge funds, that are beginning to think really hard about that. What if we tomorrow get news about a vaccine? Well, if we get news about a vaccine, everything I have told you will be completely reversed. Then, of course, people go out and shop immediately. Old generations will go out and shop immediately. People will be thinking about housing very differently immediately. You will just have a whole different outlook. So as much as I don't have a view on whether we get a vaccine, all our doctors will only get a vaccine in 2021. But if there is this upside risk that the consensus expects no vaccine, no vaccine, no vaccine, and if there is suddenly a headline that things look better, that could, of course, also dramatically change the outlook and, of course, the asset valuations of many things in CMBS and in residential real estate.
Although even if there's a new vaccine, it's going to take a while to ramp up manufacturing of it.
But markets will react. I completely agree, and it would take a while before you and I, Richard, would be getting the needle in our arm, but it was certainly, markets would react immediately if there were such a headline coming through.
So I'm going to add a little bit to, so James had another aspect to his question that I thought is interesting. I'm going to broaden a little bit about international capital flows. So you talked a little bit about Fed credibility and how important that was to our debt, but more generally, how is American real estate going to look relative to other real estate around the world? We know it actually has been a large absorber of foreign capital, Canadian more than any other kind since the Chinese have left, but still the Norwegians like American real estate, the Germans like it, the Singaporeans like it. do you think that the relative position of U.S. real estate vis-a-vis other real estate around the world will change as a result of this, and as a result for the better or for the worse?
I think the answer to that is that U.S. real estate still looks pretty good. The problem is, and you can hear from my funny accent, maybe or maybe not, but I'm European and spend a lot of time, of course, thinking about European issues. And the problem is that with the whole situation with Italy and Germany and the European Union still, unfortunately, being somewhat challenged in terms of how much money they can spend fiscally. Remember, in Europe, they have the Growth and Stability Pact, the Maastricht Treaty, which says that you can only have a certain level of deficit. That has now been suspended. So there is a lot more spending. But unfortunately, Italy was very, very hard hit. And unfortunately, we need a lot more fiscal support to the southern European countries. So Europe will be quite busy with that for a while. There's a lot of important issues going into who finances that and who pays the bills and what are the broader outlooks for different European countries. But the big picture is that still, from this perspective, the significant support from a fiscal policy perspective in the US was so much bigger than what you saw elsewhere. In other words, US government here, everyone included, of course, Congress and administration, put together the fiscal package that was about 10% of GDP stimulus directly into sending checks to households, to the PPP program, to everything that was supporting in terms of getting the economy going in so many different dimensions. And the amount of money that was thrown at the US economy was just so much bigger than what we saw thrown at the economy in Europe. Europe decided instead to give loan guarantees, Kurzarbeit, as it's called in German, loan guarantees to keep workers on the payrolls, loan guarantees to corporates. But the short answer to your question is, because the fiscal stimulus was so much stronger and so much more aggressive in the US, I still think that the US has a better chance of rebounding quicker. And therefore, to your question, US real estate, generally speaking, aside from all the health issues, which are very complicated, but US economic data and the US broader outlook does look like it will rebound faster relative to what we have seen in the European case, and of course also in the Japanese case, and more broadly, some conversations about China and Korea looking a little bit better. It still is that the US, it looks, because of that fiscal expansion being so much more aggressive, it still, to this point, from a cyclical perspective at least, still looks more attractive.
Along those lines, I found one of your really fascinating slides was the slide that compared how things are financed in Europe relative to the US.
Oh, okay.
So Europe is 80% bank financed, and in the US, I don't remember what slice of the pie it was, but it was not, there we go. There we go. So 80% bank loans in the US, whereas in Europe, excuse me, and 20% in, I like to round 20% in the US. I mean, does this have important implications? One of the things I think about it, so first of all is, does this mean that European debt is more floating rate debt, and the US it's more fixed rate, and therefore that the corporate sector is more vulnerable to interest rate risks in the Europe area versus the US? And conversely, does that mean that the US is more subject to interest rate risk than the Europe on the financial side of the market?
Yeah, I think exactly. So I think if you think about what are the implications, let's say that we had a company and the company was not performing particularly well. We had some shock, either it was because of us or because of something happened, and suddenly demand started going down. In the US case, because the pie chart to the left is so market oriented, it's so market driven, that company would be immediately punished because the market would be saying, hey, you're having problems, so now therefore your spreads are going out. There is no sitting around inside a bank or sitting around inside the financial system and saying, okay, let's wait and see. Let's try to give them some more credit. You would immediately see the response and immediately see more sensitivity to interest rates. So in some sense, and I'm not saying one system is better than the other, but it is quite important to think about a system, the US financial system specifically. It is just much more sensitive to the market and to what's going on in financial markets more broadly, because investors follow the news about different companies. And when different companies have good news, when they're bad news, the credit spreads move around exactly in sync as the news comes in. When then a shock comes around, the one that we're facing at the moment that is very, very broad-based, then you can begin to say, okay, but if you have in the country to the left here in the US, that suddenly credit spreads start widening out because corporates are not selling any products when stores are closed. Corporates are not selling any products when there's a pandemic because they're not having any sales when the stores are closed and there's no revenue because we need to stay indoors because of the virus. Well, then the consequence, of course, is that the green and the red start widening out dramatically. which is why the Fed was basically saying, okay, we need to make financing available for corporates, which is why it was absolutely critical for the Fed to go in and buy the red and the green and buy in the corporate bond markets to make sure that financing costs were very, very low so that corporates could replace the lack of revenue that they didn't get when there was a shutdown with borrowing because of the pie chart to the left being so dominantly significantly influenced by what's going on in markets. This, of course, is very different in Europe where credit markets are a lot smaller. So the short answer to your question is you can't conclude that a bank-based financial system like is worse or better relative to a market-based financial system, which is we're seeing to the left. Some people would have different views on different dimensions, but the main conclusion still is that given the shock that we were faced with, it makes complete sense that the Fed came in and said, we're going to buy credit because credit is where all the vulnerabilities were, given that it was such a significant part of the financing for corporates.
So, Torsten Sløk, we're coming up to the top of the hour. Again, thank you very much for taking an hour out of your schedule for us. Again, I highly recommend Torsten's stuff. When we put up the presentation, it has his contact info, so I think you'll be able to get on his mailing list. Again, Torsten, thank you very much for being with us.